Wow. Rock and rolling. Yeah, feel free to ask any questions along the way, but I've allowed a little bit of time at the end there if you've got any final sort of questions. So let's get stuck into it. Today's agenda. So I'll just give you a bit of a brief overview, a bit of a backdrop of where the budget's come from and where the government's coming from. We'll talk about super changes, which is the main one for most of our clients. Taxation, very little changes there. Social Security, once again, very little changes there, and I'll include a little bit of aged care on that in that front as well. A few other considerations as well, and then we'll have questions at the end. Don't know if anyone's got any burning questions before I get stuck into it, so they want to get off their chest. No, I'll take that silence as a no. Bit of housekeeping. For those of you who have joined the webinar, sorry if I'm repeating things. Look, I can't imagine there was a lot of money spent in this budget, but in effect, affecting most of us, financial planners and clients, there's not too much in it. So I imagine it'll take about 30 minutes to go through this presentation, unless people have got questions. If you're having trouble hearing it, yeah, please turn off your video. Feel free to turn off the video. That should free up a little bandwidth for you. So, yeah, and if I hear some noises like that again, I'll probably ask people to switch off their microphones. But let's see how we go. Give a disclaimer there. All right, overview. So I just thought I'd give a bit of perspective on where the government was coming from. But also just some important notes before I get into that. Just a reminder, and most of you have been around for a few years and you've seen many budgets in your time. But just a reminder, people forget that it's passed through Parliament. Houses, it's got to be passed by Royal. And generally that's a formality, the Royal. I can hear a bit of background noise there. Some grandkids maybe in the background. If I can get whoever's got some grandkids in the background just to turn your microphone off, that would be great. So, and there was a little piece of wording in the speech, the budget speech, was about most of these measures will come into effect in the July after it has received royal assent. Okay, so getting royal assent by 30 June this year is probably going to be unlikely. So that's why you're going to find most of these measures are going to come in the following year. Whereas a lot of budgets in the past, they come in almost pretty quickly. Okay. There's a couple of measures there. I think there was one measure there that I'll cover off on that actually might come into play straight away because it doesn't actually have to go past Parliament. So I'll touch on that in a second. One of the things, just a good summary. If you don't like my summary, you can go to that website there, which is the government's website, on just a bit of a summary on the budget and a bit of an overview on all the things I'll talk about today, but also a few other things that I won't talk about today, just in case you're interested. So where's the government coming from in terms of this budget? Now, if you all recall, the budget before the pandemic, the COVID pandemic started, the Australian economy was in pretty good shape. The budget was in balance, so we didn't have the debt. The government had worked hard to get to that spot. And that helped them and made it a lot easier for them to go and spend the $291 billion that they've already spent or allocated to help the economy recover. Just a couple of things that, because of that and because the Australian economy's recovered quite well, a lot better than they had forecast. Unemployment rate, for example, did not reach the 8%. It's reached about 7%, just under the 7%, and it's declining as well. So that's a good sign. Things are going well. Things have got back to normal. The lockdown hasn't gone as long as first expected. So that puts us in good shape, which therefore gives the government confidence that they can spend a bit more money to continue with the recovery. So that was just an interesting graph that I saw there. Yep. The other one was net debt in terms of a percentage based according to our GDP, which is our economy, our gross domestic product, as GDP stands for. And this is a percentage of debt as a percentage of the GDP. So they terms GDP is how the number that we put on how good and how big our economy is. For example, our economy is about just over the $2 trillion mark, which is equivalent to, let's say, in relative terms, the US stimulus package, which, if you recall, Biden came out and said we're going to spend about $1.9 trillion, sorry, and he's spending another $2 trillion as well to continue to stimulate the economy. So just gives you a bit of an idea. Our economy is equivalent to their stimulus package. So our stimulus package is pretty minor compared to what the American stimulus packages are. Just a few interesting facts that putting a bit of perspective on where the government is actually spending the money. So the $7.8 billion in tax cut is actually only one tax cut, is one tax thing, and I'll touch on that later. Business relief, I won't get into that too much because we don't have too many clients in business, but they're spending about $20.7 billion in tax relief. Infrastructure, an additional $15.2 billion. Now, most of these numbers are actually additional to what they've already allocated in previous budgets. One of the surprising ones was the aviation tourism. I thought they might have spent a little bit more in that respect. Because that's the industry that's been struggling the most in terms of economically. But then I thought, well, maybe that's because we're not likely to go overseas for a couple of years now. So why are we spending extra money on that sort of industry? So yeah, maybe we'll see a little bit more spending in the years to come. The biggest one was the NDIS aged care mental health area. That one's a big issue for a lot of people. So they've allocated an additional $32 billion in that space. So I'll touch on aged care a little bit later. The domestic violence against women, that's been pretty topical in the media, which is understandable. But they're only allocating $1.1 billion. So it's not a huge amount, but I thought maybe they could have been allocating a little bit more there. But anyway, I just thought some interesting facts. Another one, I don't know if anyone listened to Josh Frydenberg's, the Treasurer's speech at all. One of the interesting things I thought of that was that the word $1 billion. I was just listening to myself like 10 years ago, 15 years ago, how it was $1 million back then. Okay, now it's the word billion, and trillions coming in there as well. I just noticed billion got mentioned about 36 times in the speech, as opposed to million, which was only 17 times. So it just goes to show how the economy's grown and those numbers, and we're talking trillions now as well. So yeah, I just thought that was an interesting piece of information as I listened to the speech. All right, any comments on that before I move on to the next? Once again, silence, I assume means no. Super. So this is the area that affects most people. Once again, not too many changes in the super areas that will affect too many of our clients. As a financial planner, we always dread coming up to budgets of how many changes are going to come into place, what strategies we've got to think of. Thankfully, there weren't too many changes, but most of the changes were fairly positive with a few opportunities for some planning for some clients, and not all clients. One of the things you've probably seen in the media a little bit was the super guarantee, which is that compulsory contributions which came in during Paul Keating's time in '92, which started off about 2%. And back then, the minimum threshold was $450 per month. So employers did not have to pay super guarantee if they earned below $450 per month, if an employee earned less than $450 per month. So there was a bit of, I think the government's just trying to update this piece of legislation to make it a little bit fairer and coinciding with trying to cover that gap of women not having enough super or not having as much super when they retire. So there's a fair bit of gap there, and just trying to help those low income workers that don't earn too much. They're just doing a little bit of extra work to try and top up their household income. So there's reports that that's potentially going to help about 300,000 low income workers, which 63% of them are women. Now, the reason I think they can do that, because over the last few years, they've made it easier for employers to report income and super contributions and those sorts of things through things like single touch payroll. And all that means is each pay gets reported to the ATO. Super contributions now go through the ATO. So it makes it a lot easier. So there's no reason to have that minimum threshold of $450. So that means more people are going to get paid that compulsory super. The other thing that I took note of was there was talk about not increasing the super guarantee rate up to 10%, which comes into effect 1st of July. Well, that's actually going to continue. So it will increase to 10%. And that gradual increase up to 12% will continue as previously planned. That's probably good news for some people. The work test. I don't know how many people are aware of the work test or have been restricted on being able to put more money into super as a result of not being able to meet this work test. So all the work test is meeting the 40 hours, being working 40 hours in a 30-day consecutive period. Okay, so basically to meet that work test, to allow people to put extra contributions in super over 65, you had to meet what's called this work test. And the previous budget was they increased it from 65 to 67 for certain areas. Now they've decided to scrap the work test for non-concessional, which is personal contribution, spouse contributions, and salary sacrifice contributions. So they've scrapped that work test. You don't need to meet it anymore up to 75. So that means you've got to be 74 at the start of that financial year or during that financial year. This is one of those ones, look, a lot of the wording's coming out that it'll come into effect 1st July, so over 12 months away. But I think this is one of those ones that can be easily changed. It's just a regulation change. It's not a legislation change. So they might be able to do this fairly easily, which means it might come into effect 1 July 2021. And that's something that we'll be keeping an eye on. To do that. So I've got a bit of a case there, which I'll talk about in a second. One of the things we were waiting on Parliament to pass was the bring forward rule. So they had rules that you can make personal contributions up to 67 or 65 and 66, but they didn't change the regulations to include the bring forward rule. And the bring forward rule means you can bring a couple of years forward and contribute a bigger lump sum all in one go. This new scrapping of the work test means that the bring forward can be used up to age 74, which provides potential opportunities there. Opportunities are things like if you receive an inheritance. Normally we'd be saying to you, well, you can't add that to super at all, okay, because you're over 65. Now there's potential opportunities that we can add more into super. And that means potentially, assuming most of you are on pension, is you can roll back the pension into super and then add extra contributions and start the pension again. One of the areas that it's not been scrapped is for when you're making a personal deductible contribution. But what that means, if you've got an investment property, for example, or you've got some shares and there's significant capital gains there, you can't make that deductible contribution and offset and reduce that capital gains tax liability when you're over 65. Okay, so it's not going to, it doesn't cover that, unfortunately. So you've still got the complication of working out capital gains and what implications that's going to have on your tax liabilities. So look, they may change that in the future, but at this stage it's not. So just a bit of a case study for the work test relaxation. So I talk about inheritance and maybe selling home or selling investment property and having extra funds in. A typical strategy that we would do for some clients is, and this is particularly if you've got superannuation or a pension account and you've got what's called taxable component inside that, and if potentially your super or pension is going to be paid to adult beneficiaries, then there's the tax beneficiaries or the dependent beneficiaries, non-dependent beneficiaries, I'll get that right in a second, will pay tax on that taxable component. So just a bit of an example to hopefully put that in perspective. If we've got Sophie, has got about 550,000 in super, not working, got no partner, and their only beneficiary is their adult child, and they want their super to, or Sophie wants her super to go to an adult child beneficiary. And let's just assume in the taxable component is 100% taxable. So that means 550,000 would be subjected to what's called a beneficiaries tax, which is 15% or 17%. That adult child would actually lose about 73,000 of that in tax, which is a significant amount of tax. Now, with the relaxation of the work test, that means we've got opportunities to eliminate that tax by drawing it out of super and then contributing it back into super via the relaxed rules, because we can contribute up to 110,000 now from 1 July 2021. We can contribute up to 110,000 into super. Previously, you've probably heard us say the number of 100,000. Well, they've indexed it from 1st July 2021. So potentially for Sophie, you can eliminate that tax in full if you do it over 5 years. Because she's 69, we've got 5 years to do that. Let me just put it in a little bit, maybe, more realistic figure. Let's say if Sophie only had 225,000, once again, it was 100% taxable. That's potentially saving of, what's that, 36,000 over $37,000 worth of tax that would go to the beneficiaries. So that's a fair bit of tax. For only, let's say, a superannuation fund of 225,000. So it's worth, if you're wondering if that affects you, talk to your advisor about that, because I've been doing quite a few strategies with that for clients where we bought the Newcastle RI business, and we've been coming across a lot of clients where that strategy comes into play. So talk to your advisor if you think that's relevant. One of the things, obviously, as a financial plan, we take into consideration is cost of any withdrawals, time out of the market, because you've got to pull it out of super and then put it back into super. So there's potentially timing out of the market. That could be 5 days, could be 2 weeks, depending on your circumstances. So yeah, there's potential opportunities for that removing that work test. Anybody got any questions? Is that clear? Anybody got anything? Any comments?
Doesn't fit me anyway.
No, all good. One of the other interesting ones, I don't know if anyone's thinking about selling the house, but and you probably heard us talk about the downsized contribution. So at present, anyone over 65 and downsize their home, which is their primary place of residence, they can contribute up to 300,000 into super. Okay, so an opportunity for someone over 65 that couldn't put into super to contribute 300,000. They've actually decreased that age from 65 to 60. So if anyone in between that 60-65 is looking to sell their home for various reasons, they're moving or they just want to downsize because their house is too big and they can't manage it, there's potential there to add extra funds into superannuation, and that's up to 300,000. The same rules apply that's in the current rules, which, for example, the 10-year, you've got to have owned the home for at least 10 years, whether that's partial or main exemption. Plus, also there's you've only got 90 days to contribute into super after settling your home. So those rules haven't changed. It was all about, well, we're going to allow people between 60 and 65 to take advantage of those rules. So what that means is basically anyone between 60 and 74 can add to their superannuation to get the tax benefits of putting money into superannuation. Okay. So, for example, you know, if you sell or a couple sells a $1.2 million house, you live in Sydney, or you know, even Newcastle now, that's not unheard of, having apartments, houses worth $1.2 million. A couple can potentially contribute that into super. So there's potential opportunities there. That's a downsizer. Other considerations which weren't really talked about in the budget, but so I guess it's more of a reminder. A lot of our clients took advantage of the reduced minimum pension payments since COVID hit. And all that was the minimum pension was halved. So instead of, for example, 5% you had to take out, you only had to take out 2.5%. If your minimum was 6%, you only had to take out 3%. That is actually going back to normal minimum pension rules. Okay, so anyone under 65 is 4%, anyone between 65 and 75 is 5%, anyone above 75 is 6%, etc., right up to 94, which it turns into 14%. Okay, so that's still coming into play from 1st July, that you'll have to take out that high minimum pension payment. I don't know if the next one impacts too much about the transfer cap. All that is about, in effect, the maximum you can have in a pension, which is a zero tax environment. Before 30 June, or currently it's 1.6, that's actually been indexed to $1.7 million. Okay? So if you're already maxed out your cap, it doesn't affect you. If your super and pension is below $1.7 million, it doesn't affect you either. But it's just one of those things coming in from 1 July 2020. It doesn't impact other contributions and other things as well, but in terms of most of our clients, it doesn't really impact us too much. Once again, talk to your advisor. So they are basically pretty much all the superannuation changes. So like I said, there's a couple of good opportunities for some people. But there's no real major change. So like I said, as financial planners, we're going, yes, excellent. They're not mucking around with the superannuation rules too much. And what they are mucking around with are generally positive things. So that was actually good for us and good for most of our clients as well. All right, taxation. Like I said before, there wasn't too much in taxation. As much of this really the only change is extending this low and middle income tax offset, okay, which is pretty much costing the government $7.8 billion. It's a significant amount for really such a small change. And all this means is that employees will continue to get that tax offset that they were getting over the last year or 2 years, which is about this low and middle income tax offset. So if your income's anywhere between 37,000 and 126,000, you're getting this extra offset. Okay, so the offset increased from $255 to $1,080 up to $90,000, and then it slowly decreased from $90,000 down to $126,000. So that's just been extended. Okay, so it was meant to stop at 30 June this year, but it's been extended till 30 June next year. So it impacts a lot of employees that are in those middle income brackets. I don't know, this probably doesn't affect too many people either, but I'll just touch on based on this. Usually they're mucking around with the marginal tax rate. In this budget, they haven't changed the tax rates at all. So those changes that were coming in, which aren't coming in until 1st July 2024 anyway, and it only affects the higher income. So basically on the left-hand side, they're the current thresholds, and from 1 July 2024, they're just simplifying. So getting rid of a couple of those levels of marginal tax rates would just make it a little bit easier for people. And of course, people are going to save a little bit more tax there. So just in case anyone was interested in that. A few other things. Once again, it doesn't impact most of our clients too much, but I thought I'd just touch on them anyway. Small indexation to the Medicare levy thresholds. So they're the thresholds. I have got on the next slide. They're the thresholds that tell us when people have got to start paying that Medicare levy, which is that 2% Medicare levy. So which majority of employees pay. So that's changing just due to indexation. So I was always planning on happening anyway. Small businesses, and they're small business meaning businesses that have got turnover less than $5 billion. They're basically talking about being able to claim depreciating assets for up until 2023. So what that means, instead of depreciating, they're claiming the full depreciation on those assets, which I think was about up to 150,000. So there's significant benefits for small businesses. And I guess as we heard the government talk about that, this is all about growth. It's all about building the economy up. So it's trying to help those smaller businesses, which is a big part of the economy, to take advantage of those depreciating assets. So instead of having to depreciate them, they can claim a full deduction straight away. The carryback. So this is especially for the COVID, this piece of legislation was about if a business made a loss in a particular financial year, mainly because of COVID, because they were significantly impacted by COVID, they can look back on their previous profit years and offset those losses. So backtrack and do those previous tax returns and reduce their profit, therefore getting tax refunds because they've repaid tax in previous years, claiming that back. And that's all that's about. Another one, simplifying employees, doesn't really impact too many people. It's employees that receive shares from their employment. Some of you might have had it in the past. They're basically just reducing who that impacts in terms of when you left the employer. Generally that triggers a tax event. So therefore you had to declare, if you made profit on those employee share schemes, you had to start declaring that. They're basically removing that and making it a little bit simpler for people on those employee share schemes, and meaning they can delay any profits till later in the year or later in their life, up to I think a maximum of 15 years. The other one, which I always found interesting because people don't realise that, claiming self-education expenses. There was a threshold you couldn't claim the first 250. They're actually scrapping that now. So if you've got education expenses because you've done a uni degree, or you've done a TAFE course, or you've gone to seminars, or you're self-educated and you've got some expenses, you can't actually claim the first 250. A lot of people don't even realise that, where they're actually scrapping that rule. So that just makes it a little bit simpler than having to deduct the 250 on what your self-education expenses are. So that was a little bit more that I guess they're spending on that taxation side of things. Medicare levy, they're the thresholds. I won't talk about that too much because it probably doesn't affect too many people, but they're the thresholds there that are proposed. And all it is mean the thresholds have been indexed up. Okay. Any questions on the taxation side of things? No. Social Security and aged care. Social Security, they didn't really change too much. Aged care, they did a lot of spending. There was a bit of increase in the childcare subsidy. There's a bit of talk about that, and the main thing was supporting families with 2 children, which was increasing how much you can claim from childcare. So the maximum that you can claim at the present for a second child is 85%. They're just increasing that up to 95%. So that was really the only change on that respect. Improvement to pension loan scheme. There was a bit of, I don't know any clients that actually taken advantage of the pension loan scheme, but they were just improving in terms of eligibility on that pension loan scheme. So there wasn't too much of a major change on that one either. So Social Security, they didn't change anything about the age pension or disability support pension or DVA. They didn't change anything in that respect. So that was actually good news on that. So nothing really to speak of there. So, yeah, look, obviously we all heard about the Royal Commission and how badly our ageing population or ageing people are being treated in a lot of these aged care facilities. So obviously the government's had to react to this. They've decided to spend an extra $17 billion over the next 5 years on various aged care, whether that's residential, whether that's home care. The main area that they were focusing on, the home care area, something that I hear a lot is look, you know, you're not getting me out of this home unless I'm in a box, in a wooden box, because people don't want to go to hospital. They don't want to go to hospital to die. So home care is I guess an expanding area and the government's made a bit of a priority on this. They really just want to spend more money on this. So they've allocated an additional 80,000 home care packages on top of the other 80,000 they'd already allocated. So this is in addition to what they've already allocated in previous budgets. And that's going to be over the next 2 years. So 40,000 the following year and 40,000 in the year after that. Then I just looked into a little bit of the detail of that in terms of the aged care funding overall. And you can see by the bar chart below there, it's all it's really doing is continuing on with that gradual increase in spending on the aged care sector. So I was expecting to see a little bit more of a jump up because of this additional spending, but I'm not seeing that. So, you know, I guess I question whether it's enough to help our aging population. And of course, we have a lot of conversation about aged care with a lot of our clients, whether it's for themselves or whether it's for their parents. And I just question whether they're doing enough in that respect, especially since we've had a Royal Commission, especially since some of the outcomes of that Royal Commission. I was expecting a little bit more than that. So, and especially when the economy's done so well as well. So I would have thought there would have been a little bit more allocation, but obviously they haven't. They've actually made that decision. So it'd be interesting to see how Labor responds to that tonight when they have their response to the budget. Yeah, housing was another big area, and you've probably seen that in a fair bit of the media as well in terms of housing. We've got housing shortages, there's not enough housing, etc., etc. Housing's costing significant amounts, and it's hard for younger people to get into the housing market. So they've changed a few things, and you've probably heard the first home saver, the first home this, the first home that. There's lots of schemes out there. There's the federal one, which I'm just focusing on today, and then there's all the state first home grants as well. So there's a lot of grants out there, a lot of money being spent in this area to help the younger people, families get into homes to stop them renting, because there was a bit of a rentage housing shortage, but now immigration has basically ceased. The renting is more available for people to rent now, but people want to get into their home. The government recognised that people want to be in their own home. They don't want to be spending their hard-earned dollars on rent to help pay someone else's mortgage off. So one of the interesting ones, which is a new grant, I guess guaranteed, and potentially this is from 1st July as well. They've allowed for 10,000 guarantees over the next 10,000 guarantees each year for the next 4 years. And this is focused on, I think this is more focused on women as well, to try and help women improve their financial situation, and targeting those single women, but it is single parents. And you've got to have a dependent child to take advantage of this guarantee, which allows, I guess, generally they're going to be low income people, to only have a deposit of 2%. Okay, which to me that concerns. If they're low income, they're going to have to borrow more if they're only having a deposit of 2%. So that, I guess that concerns me a little bit. How are they going to afford to pay off this loan? They're going to have it more accessible, so they're going to make it easier to get the loan, but then they've got to pay it off. And I guess that little bit scares me a little bit in terms of offering these sorts of things. But on the positive side of things, hopefully it will allow single parents with dependents to get into the home, which most people are dreaming of. Key thing is taxable income's got to be less than 125. So they're assuming anybody over 125 can afford to buy their home anyway, and should be able to afford to save up for a deposit of whether that's 5% or whether that's 10%. So that was one of the new ones. Extensions on some of the other housing grants or stimulus measures, extension of the first home loan deposit scheme, and that can be for new or fairly newly built homes, and so that's allowing people to only have a 5% deposit in terms of having generally a 10% or even a 20% deposit. And the main purpose of this is to help those people not have to pay that mortgage insurance, which I don't know if any of you paid mortgage insurance when you bought your homes or bought investment properties. Generally, if you got and generally it was about 20%, you had to have a 20% deposit to avoid that mortgage insurance. This is just enabling, the government's guaranteeing the rest of the 15% or 5% to avoid that mortgage insurance. And we all, I don't know if you recall, mortgage insurance is a very expensive insurance to take out when you buy your home. So they're just trying to help people or help make new homes more affordable. The other interesting one, which kind of relates to super, but it's more about the housing side of things. And I don't know if you recall, there was this first home super saver scheme that they brought out a few years ago, and that was to help young people save for super without having to pay their high tax rates on their marginal tax rates, which I had that table up earlier. So what that means is being taxed at, instead of your marginal tax rate, you're taxed at the superannuation rate, which is 15% effectively. So typical person earning around $60,000, $70,000 were any interest on that, they would be taxed at 34.5%. This is allowing people to save money inside super and therefore only paying 15% tax on any earnings of that savings. It only related to voluntary super contributions, so where you've actually decided to salary sacrifice or you've put in personal contributions, and that's what they're voluntary super contributions. What they've done, what they're proposing in this budget is increasing the limit, which was 30,000 per person, so 60,000 for a couple. They are increasing that to 50,000 each, so allowing you to save a little bit more to save up for a bigger deposit for your home and get that tax savings. Okay. One of the key things the limit is each year how much you can contribute is 15,000 each year. So they're basically just extending so 15,000 was typically, you could say 2 years worth. They're extending that. So you can save over, let's say, a 3-year period. You can save over a 5-year period if you want, but the limit is 15,000 per year, up to 50,000 in total. Okay. So that annual limit hasn't changed, but the total limit has changed. Okay. So obviously that doesn't affect most of you guys and most of our clients, but having that conversation with your children or grandchildren, at least you're a little bit informed on that respect. So any questions on that? Is that no? Very quiet audience I've got today. Mm-hmm. So that's pretty much it. That's pretty much, I think, the key things that affecting most of our clients. Once again, I reiterate, this is one of the first slides I had. It's got to go through the Parliament, and it's got to pass Royal Assent, which is just a formality. And most of these measures aren't going to come in for over 12 months anyway. Okay, but worth going to that website, the Budget Government website there that I've got the link there. Pretty straightforward. Just search government budget and 2021 and it will come up. That's it from me, unless anybody's got any questions, or hopefully that was informative, made sense. And yeah, if you haven't got any questions, that's pretty much it. You know the team and the typical disclaimer. Anybody got any
Thank you.
questions?
You've made it very clear.
Oh, thank you, Mitzi. Thank you for that feedback. Hopefully I haven't bored anybody else. But just trying to simplify what the government's talking about. And hopefully I've done that.
Yeah,